Hi everyone, I would like to welcome all of you, especially my dear learners. This is Digital Learning Initiative by the Department of Collegiate Education, Government of Karnataka. Myself, Narsimhamurthy TN, Assistant Professor and an in-charge Principal, Government First Aid College, Medigeshi, Madhugiri Taluk, Tumkur District. I would like to discuss a small concept in Introduction to Income Tax, that is person, income and casual income. We must all of us know that every person who is citizen of India is liable to pay the income tax to the government whose income is exceeding the exemption limit prescribed by the Income Tax Act 1961 is going to be pay the income tax pay the income tax with the prescribed rate by the act to the government. So in that person under section 2 subsection 31 of Income Tax Act 1961 defines the various persons is like, that is an individual, an Hindu undivided family, a company, a firm, an association of persons or body of individuals, a local authority, and a artificial juridical person. So here the individuals. Who are the individuals? Any person who are under natural human beings is called an individuals, whether he may be male or female or majors in the sense who are above the age of 18 years, minors, that is below the 18 years, some of minors who earning incomes is also treated as an individual person as per Income Tax Act 1961, and senior citizens above the 60 years up to 80 years is called senior citizens, and super senior citizens. Super senior citizens under the in between the age of 80 years, above the 18 years of natural persons is called super senior citizens. And we are going to be discuss the next person is Hindu undivided family. In various parts of India or in earlier days, a large number of family members lives in a single family. That is, they are the relatives, they are the brothers, sisters, uncles, aunts, grandparents, grandforefathers, all are comprising and living in a single family. So that type of family is called Hindu undivided law. Income Tax Act 1961 provides an opportunity to tax the income of such type of families. As per Hindu law, it is created an relationship with the application of Hindu law. So it gives an opportunity to tax their income of Hindu undivided family. So, HUF family consists persons of common ancestors or relatives, and the manager or the head of the family or the senior male member of the family of the HUF is called Karta. He is a head of the Hindu undivided family. That person is called as Karta. Here, that Karta is liable to pay the income tax of Hindu undivided family. He is a responsible person to pay the income tax of such family. In earlier days, there is a larger income will be obtained by that such families. So, the tax is to be paid by the Karta. And the another one is we are going to be discuss the company. Another type of person is called as a company. In company, we have further classified into Indian companies as well as foreign companies. Indian companies, in the sense, it is a company or an artificial person registered under Indian Companies Act 1956. Whether it may be a private company or limited company or public sector company, whatever it may be. Any type of company is registered under Indian Companies Act 1956 is called as a company, and the foreign company also pay the income tax to the government. And then we are going to be discuss about the another type of person is a firm. Firm in the sense partnership firm. All of us well known the partnership firm is an entity, is an organization, is a platform which comes into the existence as a result of partnership agreement. It is an association of persons of two or more persons. When two or more persons are having a common interest of doing a business and they combining together with the running of small business with a common agreement, that is we call it as a partnership firm. So, and that partnership firm, it may be a partners is going to be having a limit liabilities unlimited or liabilities to be limited. It will be depend upon their partnership agreement. Let us we think the new type of partnership firm, that is limited liability partnership firm. Here, one partner's liability is unlimited and the rest of partners' liability is limited. This is a new type of partnership firm came into the existence and doing a business. Here, one partner is liable to pay the liability is unlimited and the rest of partners' liability is to be limited. And the next topic is or the person who is going to be pay the taxes association of persons or body of individuals. So here association of persons are the group of persons. Association of persons as well as body of individuals, both are the group of persons. It may be in an association of persons, it is a group of persons, whether it is a partnership firm or company. It is a group of persons or individuals is combining together is called as association of persons, and body of individuals is by operation of law. Groups of individuals only. Here there were no company and there were no partnership firms are existed in the body of individuals. In this case, only the group of individuals are there. In case any individual member is going to be dies or anything there, their legal representative will be continue the business. For example of association of persons and body of individuals are cooperative societies, NAFED, MARCFED, etc. And another concept, well-known concept, the type of person is a local authority. A local authority are the local governments. We call it as in another terms, it is a local governments. Local governments in the sense it is a government department or government authority whom government has granted power. Say for example, Grama Panchayat, Taluk Panchayat, Jilla Panchayat, municipalities, metropolitan cities, and any other type of local government which is established by the government and granted some powers is called it as a local authority. And the another one is artificial juridical person. It is a person which is established under the special act of legislature by the government. A government has to be started or established by passing a special legislature in the assembly or parliament. For examples, universities, schools, colleges, etc. So these are the artificial juridical persons. And we come to the know after knowing that persons, we come to discuss the income. What is income? What is income? Is it right? Before going to be levying a tax, first we must know, we must understand the concept of income. Here, income means any monetary which is derived from definite sources with some sort of regularity or expected regularity. So, concept of the income derives, it is a monetary benefit derived from definite sources of income, or definite sources with sort of some regularity are expected to be regularity. So such type of income or monetary benefits is treated as an income. So Income Tax Act 1961 section 2 subsection 24 defines very clearly the concept of income. Here there are major five heads of incomes are there. That is, one is salary income, income from house property, income from capital gains, profits and gains from business or profession, income from other sources. So these are the five major heads of income to any person. And then we discuss in detail the income includes. What are the components of income? Or income is going to be includes, it contains the profits and gains, dividends from companies, or cooperative societies, voluntary contribution, the value of any perquisites or profits in lieu of salary. Perquisites are the extra monetary benefits paid by the employer to the employee. It is also treated as income. Profits in lieu of salary. Any special allowance or benefit. Any allowances granted to the assessee. The value of benefit or perquisite. The obligation of assessee paid by the company. The obligation or liability of the assessee is paid by the company is also treated an income. And profits and gains of business or profession is also called an income. And income includes any interest, salary, bonus, commission, remuneration received by a partner of a firm. Any interest, whether it may be bank deposits or any loan interest, anything, that interest, salary, bonus, commission, remuneration received by a partner of a firm, and any profit on sale of license granted, any license granted, cash assistance received or receivable by any person against under export under any scheme of the government of India. Cash assistance given by the government is also treated as income. Any custom duty or excise repaid or repayable to any person against exports. Any customs duties or excise repaid or repayable to any person against exports. The value of any benefit or perquisite arising from business or exercise of profession. It is also called an income. And another components of income contains any capital gains, the profit and gains of any business of insurance, any casual income, any sum received under keyman insurance policy including bonus, any sum of money or value of property received without consideration or inadequate consideration, any consideration received for issue of shares as exceeds the fair market value of the shares, the profit and gains of any business of banking is treated as income. So, however, there are some rules regarding the income. So that basic rules are there should be a definite source of income. Definite source. In case of indefinite, it is not treated as a income. Indefinite, indefinite income is comes under the casual income. Only the definite income is treated as income. Both legal and illegal comes are taxable. You earned a legal or illegal any type of income treated as taxable. Any expenditure incurred to earn illegal income is allowed to be conducted out of such income only. If any expenditure spent to earn illegal income, that expenditures is allowed to be deducted from illegal income. And income may be regular, periodical, or lump sum. That income may be regular or periodical or lump sum. Income should be received from outside. It may be in that income within a country or outside country. Anything, the income should be taxable under the head income from various sources. Receipts in kind or service having money or equivalent is treated as income. Receipts in cash, in kind, or in service having money or equivalent is treated as income. That is also treated as income. And the another rules are there. Whether a particular receipt is income or not is decided at the time of first receipt. At the time of first receipt, that income is receipt is income or not. It is to be decided at the time of first receipt. Income may be temporary or permanent. Whether it may be a temporary or permanent, it is income is income. And once income is earned, it an income whether it is received or not. Once income is earned, it is income is received or not. It is to be treated as income for the calculation of tax. Any dispute regarding the title of income will be taxed in the hands of recipient of such income. Any dispute regarding the title of income will be taxed in the hands of recipient of such income. Income may be plus or minus. Income may be plus or minus. If plus, it is a profit. If minus, it is a loss. And the another concept is a casual income. Casual income, it is a receipt which is of casual and non-recurring nature is called casual income. It may be not recurring into the nature. It is an income which is earned accidentally or rarely. That type of income we call it as a casual income. The receipt of income which is accidental without any anticipation. Without any anticipation, that income is going to be earned accidentally. That is called a casual income. And it is in nature of an unexpected windfall. We cannot expect this type of income to be earned or not to be earned. For example, the winning from lotteries, crossword puzzles, card games, TV shows, or any sort of form of gambling or betting of any form of or nature whatsoever. So, thank you for your patience hearing. Thank you very much. Digital Learning Initiative, Department of Collegiate Education for providing me this opportunity. It's a privilege and my gratitude, sincere gratitude to our department. Thank you very much.